Good morning. You're watching The Market right here on 18 now with me, Aisha Faridi, Nikunj Dalmia, Avan Dabash in the studios. And yesterday, it was a bit of a flatter to deceive kind of markets. While we did manage to scale up well above that 18,100 mark, but from there we eased off and completely gave up all of our session high gains. So closed in absolutely flat for ourselves. But a different picture this morning. You've got the SGX Nifty indicating a 0.5% downtick and a lot of global data points as well, which the market is going to be reading into. Globally, by the way, the markets have been in the red, be it US equity markets after a sharp over 1% kind of downtick, or for that matter, Asia seems to be picking up the same sentiment. And the commentary from the Fed, I guess that is something that the markets are reading into this morning, indicating that more rate hikes are warranted. And continued policy rate increases can help lock in a deflationary trend during 2023, even with ongoing growth and strong labor markets by keeping inflation expectations low. That's the word coming in from St. Louis Fed President James Bullard, and also indicating that wouldn't rule out supporting a 50 basis point March hike, would like to see the Fed get its benchmark rate to a range of 5.25% to 5.5%. And I guess that's getting the markets a little jittery, at least the US equity markets.
Natasha, I mean, what we were discussing 2 days ago when the US CPI data came, the market reaction was perhaps negligible. It appeared that time that inflation impact was more like an old story for equity market and for the bond market. But out comes the hawkish comment from the US Fed. They're clearly making a case that inflation is a concern. And the market reaction in two particular categories. I always look at the macro reaction in the dollar index, which is at 104. That's not a scary level. And the 10-year is at 3.86. Crude is moving part because a lot of other factors, including China opening up, are having impact on that. So just when it appeared that financial markets would see at least no concerns in 2023 on the inflation front, the US Fed hawkish commentary seems to be just stirring the sentiment, because 2023 so far, if you ask me, the outperformance is there in developed markets. The outperformance is there in growth stocks. Crypto is making a comeback, and these categories typically do well when worlds know that when financial markets are convinced that either interest rates will peak out soon or they already have peaked out. So it's a bit of a stir. Now let's see how things move. We are not at that kind of an alarming level in terms of when inflation concerns were at its peak. That time the dollar index was 115, the US 10-year paper was way above 4%. So we are not there. I don't think we will reach there yet. But what this will do is that it will do two things. One, it will test the outperformance of developed markets. That's been the outperforming patch this year. If global markets they peak out, will the 2022 story will be at play again, which is that India starts outperforming. In the near term, that is what you would need to monitor. The moving part here is dollar index. So I don't think there is a worry, there is a concern, but it's a wrinkle. I mean, it's going to stir the sentiment, if you ask me.
Yeah, talking about not ruling out more rate hikes. So clearly that hawkish commentary seems to be playing out on not just the US markets, but Asia as well is deep in the red, barring Shanghai. And the SGX Nifty, it's off to a negative start, down about 0.5% or so. But our markets clearly seem to be in a sweet spot right now, at least 18K being maintained. And you saw the traction building up even within the broader universe in yesterday's trading session. 3 straight days on the trot that you've seen a move on the upside. The market breadth as well remaining positive. The fact, Nikunj, as well, that adding to the mix, FIIs continue to remain net buyers. All of those seem to be putting our markets in a rather sweet place right now.
Well, it's looking much better than what it was. Imagine the market 15 days ago. Yeah. There was this Adani Group sell-off fiasco. Markets were worried about FI selling, and in general the technicals were not that strong. Those three concerns which bothered the market, let's say 15 days ago, they are looking settled now. FIs are back. I hope they're really back and they're here to stay. B, the kind of excruciating sell-off what we first saw in consumer tech and fintech and then Adani group of stocks, that's clearly behind us. Adani stocks have stabilized. and also consumer and fintech stocks are finding some buyers, and the opinion towards, let's say, Zomato or Paytm or Policy Bazaar has decisively changed. So the two large pockets of weakness in the market, that in a sense that is getting addressed. Because heavyweights are moving higher and Nifty has closed above 18,000, is there a case for Nifty now to gradually not climb, not jump, but crawl? I think crawl is the word. Nifty is crawling. In this crawl, will the buyers be positive? Well, I sincerely hope so, because you're getting support on the liquidity front, on the technical front, and on the FI, on also with large heavyweights. So it's not like going to be a Dhamakedar Friday. I think it's going to be one of those lackluster Friday with the positive bias. I think 2 weeks ago we said thank God it's Friday because markets were volatile, but I think today you would say it's okay, it's a Friday.
Yeah, because we've had better days over
We've
the
had
past.
better days. So
Yeah.
the scare in the market is over, but the excitement in the market has not returned.
Yeah, but at least we're back at that sacrosanct 18,000 psychological level. I guess that is something that the bulls can take relief from. In fact, India's bull market is alive and kicking. That's pretty much the word coming in from market veteran Ramesh Damani as well. And here's his interaction with us yesterday.
Index has doubled in 3 years, and if you expect more than that, I don't think the stock market is the place for you. I think it's done well. You pick stocks bottom up, you've done well. The index itself has doubled. Forget picking the stocks. The bull market that started when the finance minister announced the long-term rates in income tax for corporate India 25% is still intact. It's still headed higher. And I would wager to you that we're just consolidating before we move up the next leg higher. I think you need to understand the intellectual reasons why there's a band of people who seem so bullish on India, and I include myself one of them. Despite all the current imbroglio that's going on with other parts of corporate India or the sluggishness of the economy, the poor earnings season that we went through, every bull market has a reason, Nikunj, as you know. Let's say the 92 bull market, it visualized liberalization was going to take place in India. Say the 2000 bull market, it visualized India was becoming a technology superpower. So what is the intellectual reason why this market has been headed higher? Why has it doubled since the post-COVID lows? I think there are two reasons. One is demographic and one is a geographic position. Let me take both of them and explain to you. Let's see about the demographic reasons India is going up. Over the next 20, 30, 40 years, China is going to lose 250 million of its population, and India is going to add 250 million population. So India's population is still rising while China is declining. Now, what is the forecast for GDP growth? You need population growth, plus you need productivity growth. So India is in a good position to do that, if you will, because you're adding so many people, so many new consumers into the economy. The second reason is the geopolitical importance. I think the world has realized they need a counterbalance to China. And if you look at the Asia Pacific region, there's only one economy that can challenge China's in terms of heft and size, and that is India.
Okay, let's talk stocks and let's get market specific. HDFC, that's going to be one group which is going to be in focus. One of the largest bond issuances that we've ever seen, 25,000 crore rupees. Of course, it's a tenure of about almost 10 years and the coupon rate is at 7.97%. The major investors, LIC, EPFO and some of the large private banks as well. And it seems that it's an oversubscribed issue with 92 bids received already. So this is going to be an interesting development, although it's, of course, a large tenure bond or long tenure bond.
So Aisha, I think my understanding is that you could understand is that you're raising capital just ahead of the merger, and that's 25,000 crore. And you're raising it about 8%, which means HDFC, if you're committing to a long tenure of 8%, and we're talking a long tenure, that means
your view on rates.
That means your view on rates
Yeah.
is slightly different. That's one part. Second, this also means that before the merger, when the balance sheet of HDFC and HDFC Bank would be merged, there is enough and more liquidity in the balance sheet of HDFC Limited and HDFC, and so that it does not really create any kind of a crunch for HDFC Bank merger to go through. However, what this will do, which is what markets thought, that because HDFC Limited is borrowing at such a high rate, the total blended rate, return on asset and return on equity for the merged entity in the near term will remain under pressure. But at 8%, if HDFC, which is like the bluest of the blue chip paper, is raising a long term tenure, that just tells you that in the bond market right now, I think it's a good time to really lock your capital, and this is just a personal finance advice for all our viewers here. It's a good time to perhaps lock long-term capital in the bonds. You won't get 8%, 9%, 9.5%, that kind of a rate for a long time.
Yeah, and this is a move that's preceding what we saw in the month of November as well by HDFC, close to 2,000 crore rupees via a bond issue. Let's in fact listen in to K.K. Mistry, the VC and CEO at HDFC, on this bond issue and the demand trends for their bonds.
Well, the demand for good quality paper is always very strong. People are always looking for opportunities to deploy money in safe instruments. We launched the issue with initial expectation of a minimum of 5,000 crores, but we kept a green shoe option where we could go up to 25,000 crores. The actual demand we had was more than the 25,000 crores that we had originally thought would be the maximum we would get. We had demand from close to 93 or 94 odd investors, and we finally could do the allocation only to about 53, 54 people. And some of the larger funds who had sought, for whom there was a demand, we could not satisfy the entire demand. See, there is sufficient liquidity in the market for good quality companies to raise money. For us as a housing finance company, money is raw material. We have a very large disbursement requirement every month, month after month, and we have to raise money through various sources. We raise money through deposits, through term loans, through bond issues, through overseas funding, and we try to raise money from that source which gives us access to the cheapest form of funding at a point of time. So this time we saw that the demand for bonds was strong. People were looking at safe investments or safe avenues where they could deploy the money, and therefore we went in for this fairly large issue.
Let's understand the market technicals now. The SGX is indicating that we will start a shade below 18,000. So Naresh, just when it appeared that we were all ready, set and go for a breakout trade, it will get challenged again.
So that's become the case yet again, where we keep getting challenged at 18,000 mark. The same thing for the US markets also is like Dow Jones 34,300, 4150, 4200 for S&P 500. And this has been a resistance for both these indices. And every time we go there, there is a flip due to some reason. Now we go back into the same range. The only case is whether India can continue on the momentum irrespective of the global markets. It needs to be seen. So for now, the buy initiated on a breakout at 17,950 should have a stop loss at 17,800, 850 levels. Till that point of time, the index still remains positive. And overall, even if we go back, being in the range also, the bias is positive because we are seeing a lot of stock rotation, sector rotations. So overall, the bias is still positive. The momentum is getting into a question mark after yesterday's correction in the US markets.
You know, on a racing track, there is something on your marks, get set, go. Every time we see on your marks, get set, go, Nifty will go above 18,100. Somebody says, stop, 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 right?
On a racing track, there is also pit stop. And there are too many pit stops in this market actually.
That's what it is, right?
Yeah, it is. It's difficult to try and find a trend. So, yesterday was a classical case. You saw the 18,000 levels being broken. You saw the budget high being broken for the index, both on the spot as well as on the futures mark. You saw the Nifty scaling past about the 50-day moving average, even though it was a momentary break, at least in the first half or so. and the Bank Nifty showed also signs of strength, at least in the first half. But then, after yesterday's US market reaction, it's bound to be that our markets would also come back into that trading range. So the question now is that which would be the leader stocks and the sectors which could probably get shielded from this market or this phase of market correction, whether we go back to the likes of IT stocks, large cap names like Reliance, ICICI Bank, or whether the market turns into these kind of stocks and see some more selling pressure. So the texture of the markets today would probably determine that whether this could just be a reversion towards that sub 18,000 mark, or whether it's a full reversion and we are back, or we could be looking at back, at 17,400, 500 levels for the index. That I believe could probably be dependent on the texture of the markets today. So as of now, yes, difficult to trade the indexes. 18,000 was a major support. If we don't manage to hold on to that 18,000 mark, say in the first half of so, then I think it would probably be a bit more tricky to try and trade the index.
Well, would you keep the bias with large caps? And is that what's on your trading radar this morning?
Yeah, the bias would be on large cap names, but then, again, as I said, depending on how the markets open up today, what are the kind of stocks which, we'll see selling pressure, I think that could probably determine the next course of action. So as of now, I would probably stick with a few mid-cap names. Two buy calls which I'm suggesting from the mid-cap space. The first one is about Indian Hotels. The stock formed a classical base at the 314, 315 mark. So keeping the 312 as a stop loss, broadly would suggest a buy. 340 as a target for Indian Hotels. The second would be about FSL. We've seen many mid-cap as well as large-cap IT stocks doing pretty well for themselves. First Source Solutions as well has managed to break past about the 115, 117 breakout points. So would suggest a buy, keeping 116 as a stop loss, targets of 128.
Okay, and Naresh, let's understand what's going to race ahead in today's trading session according to you.
So focusing on the new sectoral rotation, which is oil and gas, which is showing a lot of strength. So the first is a buy on ONGC. The stock has given a breakout above the recent swing high. Also, the stock corrected sharply the last time when the windfall tax was announced. Yesterday, the stock went above those levels. So that's the first indication of a trend shift going on. Yesterday, volume was higher compared to the last 2 months in a major way. So seems like a technical trend change has finally come, and ONGC has been a major underperformer. Even in March, when the crude prices went to 130, the stock topped out at 180, 185. And overall, if we look at the longer term structure, it's given zero return maybe for the last 15, 18 years. Technically, today it looks like a breakout which can go towards 180, 200 in the medium term and even higher possibly. So for now, it's a buy with a stop loss at 146 and a target price of 170. Second is a buy on Mahanagar Gas, another stock from the oil and gas pack which has done nothing over the last 2.5 years. The stock had made a bottom around 700 in March 20. The same bottom got tested in 2022 a couple of times. And the return, and from a high of 1250 in 2021, the stock is still at 900 odd levels. Yesterday, the stock broke out above the recent swing high. So it's a triangle breakout as well as 4 tops around the 910, 920 mark finally got taken out yesterday. So the breakout is done here. I would expect a target price of 1050. A stop loss now would be kept at 890.
Right. Okay, on that note, let's take a very quick break. When we come back, all about stocks.
Like with almost 36.5% promoters are having the stake, 12% is for FPIs, while 4% remains for the domestic investors, especially in the institutional part. And the key mutual fund players include Quant Mutual Fund and Aditya Birla Sun Life Mutual Fund. Amongst FPIs, we have Nomura and Minerva and IDOS Fund as well. And lastly, the stock has been on a tear. It's near its 52-week high levels. Since May lows, it's up almost 111%, and on a one-year basis, the stock is up more than 60%.
Okay, we'll leave it at that, Sharad. In the meantime, let's hear out from Dipan Mehta as to why he continues to like the hospitality space and he likes Mahindra Holidays as well as IHCL.
It's better to buy the hotel companies. I think look at the way Indian Hotels reported, what kind of numbers they have reported, and some of these smaller hotel companies as well. And I would say that that's a better way to play this particular investment theme rather than the aviation sector. The hotel industry, there is anyway a crunch when it comes to capacity. It is not all that easy to increase hotel capacity. It takes at least 3-4 years to build new hotel rooms. So that's the way we'd like to play it. Another company which comes to mind is, of course, Mahindra Holiday. which is a vacation company, and that also has reported decent numbers last few quarters or so, very attractive valuations and a lot of cash on the books as well. So I think that's the way to play these two companies, rather this particular sector per se.
Let's connect with Sandeep Sabharwal as well, who's joining in on the show. Hi there, Sandeep. Let's get in your thoughts first up on HDFC with respect to that largest ever bond issue of $3 billion. What's your take given that we're looking at the coupon at about 7.97%?
Morning, Avan. I think that was the entire challenge which I thought HDFC Bank merger will face. That HDFC as such doesn't have any big retail asset book or a borrowing book, and to that extent, HDFC Bank will have to refinance a lot of this money, and there'll be SLR CRR requirements. So for example, now you see 7.97 they are borrowed at. Home loan rates, I think, are just around 50-60 basis points more than this today. So at the margin there, although this will be a not a very, this is a relatively big but not so huge portion of the overall borrowing, but still the borrowing costs are high relative to what the housing loan yields are. So I think that's what could hit the profitability of the merged entity subsequent to the merger.
Kunal, do you sense it could have a bearing on the HDFC stock and maybe HDFC Bank as well, considering it's coming ahead of the merger?
Well, I just hope that these kind of news flow, they at least lead to a breakout of sorts for either of the HDFC names. These stocks have been just lying absolutely into a trading range for last 3 months, 6 months. Even if you look at it over the last 2 years from the 2021 highs, these stocks have been broadly into a range. So it's very difficult to preempt that when would these stocks tend to break out. But the kind of news flows or the events surrounding the stock price indicates that sooner or later these stocks would break out. My sense is that whenever these stocks break out, that could be a start of a strong uptrend for these names. So difficult to forecast where how the impact of the news flow would probably happen for the HDFC group of stocks. But then I think I would probably wait out for a breakout, say 28,775, 2800 for HDFC Limited, and possibly around the 1750 to 1800 mark for HDFC Bank.
Meantime, Nestle as well, Sandeep, in focus. And in their conference call, they did sound fairly optimistic, saying that demand growth across towns is secular. They're looking at a rural play of 20%, and that's grown in double digits. What's your assessment of Nestle post its quarterly performance?
Yeah, so food businesses we've seen have been resilient. So that's something which we saw in case of Britannia also. However, specifically for Nestle, the valuations still continue to be very, very stretched. So to that extent, they might have growth, but then the valuations are so high that it's tough to make a case for significant absolute returns.
The 2-year chart of Nestle, I think, is capturing that same point, that we've seen perhaps no return from Nestle in almost 2 years now. There you go. 2021 to now, where we've seen a huge post-COVID recovery, the stock of Nestle is up 15-16%. Asian Paints, good old Asian Paints, it is the most patronized stock in terms of the most patronized stock by fund managers. Last 2 years, Asian Paints and Nestle have given same return. So these Page Industries, let's look at the third one as well. You are getting a sense that some of these so-called master franchise consumer Page Industries given better returns, I stand corrected. Some of these so-called haloed stocks are getting or entering into what is called as time-wise correction and also price-wise correction. Sandeep, incrementally it is now getting obvious that the Indian consumer is slowing down. And the category which first took the first hit was rural, and now it is impacting the middle of the pyramid as well. What would be the implications of that, and which are the stocks you think one should avoid, considering that inflation is here to stay, and the middle level category has started slowing down?
So I think, Nico, the slowdown started some time back, but people, generally the investors who held on to these stocks were not ready to believe that. In fact, company managements came out and said that there is a slowdown, but many of the investors said that we are not bothered. These stocks will just continue to go up. And that doesn't happen. Now we are at a stage where many of these stocks have actually fallen 20-30% from the top. So my ballpark sort of analytical tool, like it's not exactly a financial analysis for many of these companies, is that when they fall 35-40% from the top, that's the time we should start nibbling into them, because finally they are long-term growth stocks which will do well unless and until there's some significant negative that I see. For example, in paints, I see a significant negative with Grasim entering next year with such a huge capacity, and to that extent, the upsides will get limited. For although in the near term they could benefit in terms of margins because of lower input prices, but many of the others, people should start nibbling into them rather than becoming negative after they have fallen 35-40%.
What really caught my attention was when Zomato came out and said, oh, inflation is having an impact in our business. For a company which is supposed to be high growth, now the attention will shift from profitability to growth pangs. The stock may have not done a lot post numbers, but for me, that is a clear endorsement of where the consumption patterns are moving. Zomato is the representation, represents disposable income. And if they have come out and said that we are acquiring less new customers, we are going into small cities because large cities are slowing down, that is something which just tells you that which way the disposable income is moving. So Sandeep, that brings me to my next question. Hospitality industry is also a play on disposable income. But if I look at hospitality stocks, Indian hotels, all Lemon Tree, they're giving blowout set of numbers. So while we're talking about a slowdown in consumer, a slowdown in QSR activity, a slowdown in consumer durables, but when it comes to hospitality, that segment has become bulletproof.
It has, because there are drivers going in for that, because people are looking out for small pleasures which come from holidays, etc. And corporate travel has picked up. And what many of the people are also missing out is that foreign tourists are coming back in a big way, and that's visible if you go out and look into many of these five-star properties where you hardly used to see foreign tourists 3-4 months back. Now they are full of that, and that used to be a very big business for many of these hotels. And with this entire G2 related buoyancy, also with the G2 summit coming up, and prior to that, and that's in the off season after the holiday season. So that's, I think, and the capacity constraint issues, which all of us know about. So next 3-4 years, it will be good for pricing power. So there are a lot of things which are going in for them. So that's why, and many of these hotels have outperformed earnings so much that the sharp run up then gets sustained. For example, Indian hotels profit projections by analysts for this full year was 400-450 crores at the beginning of the year. The first 9 months itself, they have done 700 crores. So maybe they'll do 300 odd crores in the last quarter. So 1,000 crore profit this year. And initial expectations were 450 crores. So I think that's the magnitude of outperformance that is happening. So I would be incrementally still positive on hotels, both Indian hotels and Lemon.
Okay, that's the view coming in on the entire hospitality and hotel sector. Let's hear out some top fundamental ideas. Hemang Jani then talks about his bets within the cement space. Hear him out.
I think if you have any move from the government about lowering the GST rate for cement, definitely it will be positive. And I think if you look at the quarterly numbers across the companies, be it Ramco Cement, Ambuja, ACC, Ultratech was a tad, disappointment, but the numbers have been pretty good. And given the fact that this is going to be 1 year before the election, the kind of order awarding by the government is picking up pace, which is good for the cement sector, and the real estate sector anyway is doing well. So I think we continue to have positive view. I think Ultratech, Ramco Cement, Dalmia, these are our preferred picks within that sector.
All right, lots more stocks that will be in the spotlight then in today's trading session. You got Schaeffler that came out with their numbers, 21% growth in their PAT. Revenues as well have been fairly steady. Ultratech Cement has announced the commissioning of one of their cement capacities in Chhattisgarh as well as one in Odisha, so we'll be watching out for that stock as well. And then you've also got a lot of these defense counters that are in the spotlight owing to a lot of prime products that they said that have been showcased at Aero India, so we'll be keeping that on the spotlight in today's trading session as well. Let's get in your assessment then, Kunal, on the charts. What's looking good within the defense space? Bharat Dynamics yesterday shot up 12.5%. HAL was up about 7% plus.
Yeah, I would still stick with HL and BEL. I think they are more stronger names in terms of the chart patterns overall. So I think if I'm not wrong, they were the first ones 3-4 months back to start to get into a correction. I think HL and BEL both had come back to their 200 DMAs respectively. Spent some time over there. I think almost a month and a half for these stocks. There were trades or intraday trades in between where these stocks had broken below their long-term averages. But then the ferocity of bounce back from those long-term averages indicates that the leadership is coming back from the sector as such. Now the likes of Mascow, Dock, Cochin Shipyard, GRSE, etc. Some of the stocks are trading significantly below the long-term averages, which means that the pullback into these stocks has been quite sharp. And I think that's the distinguishing factor for the likes of BL and HL because of their relatively low beta as compared to the other names and the fact that these stocks hold on to their long-term averages, the trade becomes far more lucrative. So I would stick with BEL and HAL. Maybe HAL, I think after yesterday's price action, we'll wait out for some phase of correction, but I think BEL closer to that 100-105 mark still looks very attractive.
They just 8% up yesterday, 7% up on Wednesday. That makes it almost 17-18% in a matter of just 2 trading sessions. Is the BSNL order finally coming? We don't know. Nobody knows. It's been coming. It's more like this, Fox story. Share aaya. 638 rupees for Tejas, up 17.5%. That's one stock which is definitely dependent on news. The other one which is catching my eye is actually SpiceJet. Air India is expanding. Indigo has got its mojo back. Why is SpiceJet doing the way what it is? Yesterday the stock really did a pole vault, so to speak, up by about 11-12%. And by the way, crude prices are something which are again not favorable for airline companies. But the stock which I want to discuss with Sandeep, I think, is Ambuja and Adani Ports. Sandeep, there seems to be a consensus amongst fund managers and some HNI investors that if you have to buy, you should only buy Adani Ports or Gujarat Ambuja. They both have predictability about their businesses and their businesses are not that complex to understand. So 6 months from now, if we are looking at Ambuja and Adani Ports and Ambuja, do you think February 2023 will be considered as a good time to buy into some of these stocks, or they are a skip and a go?
So I think they'll be good to buy as long as the promoter doesn't get into any sort of pledge share issue because of which some forced shares happen. So I think that's the risk. And if we believe that that risk is minimal, then these stocks do offer value both in terms of overall absolute valuation and because of the way they have fallen. And because when a business is actually generating real profits, then we have to value it differently than others which are on an investment spree and where there are hardly any profits. So I would think that given the fact that I think overall market should do reasonably well, for high risk investors, I would agree that these could be bets which could pay off.
Also bring on board Jay Thakkar, who's joining in on the technicals. And Jay, just looking at some interesting movers over the last 1 week, and Tech Mahindra certainly stands out. Yesterday as well, you saw a nice power through rally, and you've also got something like a Torrent Power. Of course, that's news-based related. What's your view on the charts for these two candidates?
Hi, very good morning to one and all. I mean, see, yes, Tech Mahindra did provide a very nice breakout. In fact, a day before yesterday's trading session itself, a very good, nice symmetrical base triangular pattern that was being formed. We saw a good, open interest build up as well as volume breakout on the price charts, and I would say that further is likely to move up. So, from past 2 days, we have been seeing a good up move, but then even if at all there is any dip, should be utilized as a buying opportunity. Reason being that with this kind of a breakout is likely to take off his previous swing high of 1165. Yesterday's close was at 1130, and the targets on the upside would be around the levels of 1200. The stock on the immediate basis is likely to head towards 1200. Hence, any dip should be utilized as a buying opportunity. And I don't think that now stock is likely to trade below 1080 levels. So that would be a good reversal point as well on the lower side. As far as Torrent Power is concerned, similar kind of price structure. I would say since past couple of trading sessions, we have been seeing good long build up as well as good up move with a increase in volumes. I would say this stock is heading towards the upper end of its falling channel, and the targets comes to 530, 540 in the short term. One can definitely buy this on dips near the levels of 500, and the reversal on the lower side would be at 485.
Okay, that's the view coming in on Tech Mahindra. There was also Torrent Power that was a buzz. But in the meantime, let's hear it out then from Ramesh Damani, because he remains very bullish on a number of sectors. In particular, he believes that the defense and railway PSU space really stands out, and also says that data is the new oil and is betting on new age tech companies. Listen in.
I'll tell you the two new sectors that we've been trying to bet on. Some you may be familiar with. Data, as everyone keeps telling you, is the new oil. I mean, that's now a well-known fact out there. Now, data has a lot of components. You've got to aggregate it, you've got to analyze it, you've got to put intelligence out of it. Now, if you look at the companies in India that do specialize in data, I think their employee cost as a percentage of revenues is between 60 and 70%, which tells me two things: that this business is coming to India, because if India is paying 70% in salary costs for this business, it's clearly a business that cannot be done in America or London or Germany. It has to move to India. So there are a lot of new companies in there that are using data either to aggregate it in a database or ship it out in intelligent forms. So I think the first sector of new ideas, if you wish, is we're looking at those set of companies, because we believe that the cost basis of that business also almost ensures, given that we have now good telecommunication and cheap property prices, that the business will shift to India. The second business, which you, as you know, I've been bullish on the last few years, is particularly some of the defense and railway PSUs. And given the government's capex push in railways particularly, I think there's some very cheap stocks, I'll use that word advisedly, cheap stocks in the railway space. And if you notice the last few days, there's been a lot of noise of India becoming an export powerhouse in the defense sector. Now, if India is going to be an export powerhouse on defense, $5 billion is the number bandied around next year. I think a couple of listed companies which will have to benefit dramatically from that push. So I would say you go for data, and then I would still stick to some of the cheaper defense and rail PSUs, particularly because of the capex and export push that they're experiencing.
But are these businesses, especially the defense stroke railway businesses, are these high quality businesses? Because the top line may be great and the government commitment towards defense and railways is strong, but some would argue back and say that these are not the best of the businesses when it comes to return ratios.
Well, I disagree with that. I mean, I'll give you an example of a company that I still own, and I'm only saying it as an example, not for anyone to buy it or anything like that. So please be very careful. You remember, Nikunj, in the early 2000s, we used to buy a company called Bharat Electronics, which I own today also, but I'm not recommending it. I'm just saying that the stock from those lows, it was a 300 crore market cap, it's now a 60,000 crore market cap. So over the years, it's compounded for investors, paid a very rich dividend yield. So
Sandeep, I'm just curious to know that which is one stock you've been holding for years and years and years, and you think that you want to give that stock to Suhani, your daughter?
So I think in that category would stocks like all stocks like Britannia, where the company has gone from strength to strength over the years. It's compounded well. So there have been periods when their margins have got hit, but then they have come out of it and in fact grown their portfolio so that margins actually improve. And I think it's a business in which the food business is where in India the growth potential is still very, very huge. There will be some high penetration in some of the old categories, but the new categories keep on coming up. The food habits change, and such companies can utilize those opportunities to actually grow further.
Britannia. We must recognize that for Britannia, a lot of changes have happened ever since Varun Berry took over about 7-8 years ago. I mean, ahead of that. They got their mojo back in terms of getting the margins back, and now they're really spreading themselves, not thin, but very nicely in the categories where their core competence is, which is dairy and as well as bakery. I mean, it's not that Britannia like ITC has diversified into a lot of these, multiple categories. Jetakar, I'm coming right back to you, but Sandeep, I have a follow-up question on this one, and maybe we're going to extend today's discussion with slightly more forward-looking, stocks. Sandeep, 20 years ago, if you wanted to bet on India as the Indian consumption, the easy basket was you buy Nestle, you buy Asian Paints, you buy a Britannia, you buy a Dabur, and the entire consumption bet is taken care of. But now things are changing. Some old categories are getting mature, some new categories are getting created, new consumption and niche players are getting also drawing a lot of market share. So for next 5 to 7 years, if you have to identify one or two consumer companies which are bet on the new young millennium spending habits, which would be those 2-3 companies? Because the minute I say Britannia, HUL, Nestle, that's like old school 20-year ago wala investing.
Yeah, but then in the consumption space, unfortunately or fortunately, Nikunj, the companies don't change. So I think that's the beautiful part. The only, I think, segment which has come up and which could sustain would be all these QSR companies, etc., where they'll keep on growing and consumption in them could keep on growing, or some of the retail companies, so as proxy for consumption. But then many of them also will not change so much. So in the restaurant business, obviously there have been some new additions of companies, and I think they will be the one which will sustain. So, and now, right now, there's a consumption slowdown, so stocks could become cheaper, and one could use those opportunities to buy and hold for the long run.
Let's put the spotlight on some news as well that has come in with respect to source-based information and agencies that Minda Corp is looking to acquire a 15% stake in Precall via the reverse book building. Joining in right now is Vikram Mohan, Managing Director at Precall. Let's, just state the facts right now, because just a short while ago, I believe there was a comment made by Precall that there is no intent of undertaking any secondary sale of promoter stake and no intent to raise equity capital. What is the status currently? Mr. Mohan, can you hear me? If you could take us through what exactly is the status currently with respect to Minda?
These are unconfirmed rumors, ma'am. We have, it's come as a surprise to us as well. The promoters stand absolutely committed to the business. We have turned around the business. We are on a very, very strong financial footing. We are long-term debt-free. We have technologies in place. We have signed in the recent past technology agreements with 3 class-leading companies globally, 2 from Europe and 1 from Silicon Valley, to position our products out there. We are generating substantial cash profits which will fund our expansion plans. I've been constantly talking about our expansion plans and how we intend to double our turnover in the coming years. Our PLI application has been accepted by the ministry as well. So I don't know where this baseless information is coming from, ma'am.
Mr. Mohan, if let's say Minda goes ahead with a secondary book building offer of 15.7% stake, and where the promoters are not looking, promoters of Precall are not looking at selling or participating in any open market transaction, then it is an hostile takeover attempt.
It is not a hostile takeover attempt, if I may say so, because I have spoken ever since this news broke to certain sections of the institutional investors who are all very, very strongly backing us at this point in time. So I don't see how it could be a hostile takeover attempt. Secondly, our share price closed at 209 yesterday. I don't see any reason why shareholders will sell at 209 at the current market price.
You know, but that's exactly the point, Vikram, because it's a sizable block deal, right? Almost 4.2 to 4.3% equity has changed hands on the exchanges. So what's the next game plan now? Any firefighting, any ammo that you would have in case, this turns out to be a hostile takeover? Who bought, who sold, that we'll only come to know later this evening?
We are working with our investment managers and our internal armory to see what else we can do, because I think it's a little early in the day right now. But we stand committed to this business, and that's all that I can say. And we will not allow a hostile takeover. We will have our counter offers if necessary at the right time.
What is the current ownership of the promoters, sir, in the company?
It's 37%.
Okay.
It's 37%.
Would you be looking at increasing your stake from the open market operations?
Not at this point in time. I wouldn't like to comment on that.
Do you have any existing business relationship with Minda, or this is more like a bolt out of the blue suddenly coming out which you were not aware of?
This is a complete bolt out of the blue that I was not aware of. We have absolutely no business association with Minda. In fact, they are our competitors. And so this has come as a bolt from the blue, yes. And I don't know how much of credence to give to this information also, because I am getting counter reports from the market saying that this is just a rumor.
Well, we don't know, so we have not got any confirmation from Minda. So, I think as of now it's completely speculative. But just to clear the air on this one, and I don't want to get this one wrong because this is going to be a price sensitive information. If there is an open offer bid by the Minda Group, would Precall be taking any countermeasures? Because 63% holding is still in the public domain.
We will take appropriate countermeasures, yes.
So you are protected to take care and protect your interest in the company.
Absolutely.
And what you're confirming to us is that the promoters are not looking at participating or reducing their stake, and you're fully committed to Precall.
1,000%.
What gives you the confidence? I mean, if you get a good deal, why not get out? What gives you the confidence that you want to just stay committed to it? It's not that first time promoters have not sold out.
I am committed to this business because I know exactly what are our growth prospects. We are on the cusp of, a large growth wave. Our market share has increased. We have a very healthy order book. We have a very healthy cash flow. So why would I want to sell when my company is seeing a big growth curve in the coming 2 years? 2 to 3 years.
I have one more follow-up question, Vikram. Thank you for patiently answering all our questions. Is there a promoter pledge also which could be at risk?
We have 0% pledge in the company. And we have, as a Precall group with other unlisted companies in the group, all companies are debt-free and have cash reserves as well. And there's not a single share that's been pledged by the promoters.
Vikram, really appreciate your time. So glad you could accommodate this interview request, and thank you for patiently and candidly answering all our questions.
Yeah, thank you.
Okay, now this is very interesting. Very, very interesting. It's rare that you see stories and you see instances like this where there is an existing management which is not looking at selling out their stake, and there is a competitor who is looking at buying the company without the consent of the current promoter. The open offer which the Minda Group has done, I think it is lower than the current market price. or the management of Precol is telling us that they are fully committed to run the business and they have support of individual institutional shareholders. The trick here is that the public holding here is 63%, and 63% public holding is the tricky one to call. The promoter of Precol, you just heard, they do have confirmed to us that they have not got any information on the same, but if they do, they could consider any countermeasures, which right now they're not sharing with us. But it's rare that you see such instances where the promoter group is not looking at selling out, but the competitor in this case has gone and made an open offer. Now that's completely source based, but that is something which is going to make this entire story very, very interesting, at least for the next couple of days. Meanwhile, markets, if you turn attention back there, 18,000 on the Nifty intact. In the pre-open session, Sensex is indicating that it could be a negative bias.
Let's reconnect with our chartists to find out their mid-cap ideas. Of course, we'll be keeping both of these stocks very closely on our radar once we open for trade. So what are the mid-cap strategies, Kunal?
I'll go with ABFRL. I think the stock has formed a classic base at the 250 odd mark, spent almost 3 weeks consolidating at those levels. Similar was the case with the charts of Trent when we spotted the stock sub that 1200 mark. It done pretty well for itself. So ABFRL is what I would recommend as a buy. Similar charts, targets of 270, stop loss to be kept at 254.
Right, Jay. What about your mid-cap ideas?
Sure, I've got 2 buy recommendations out there. I mean, the first one would be on Oracle Finance. One can buy this targeting 3350 to 3450, and one can place a stop loss at 3150. This stock too has formed a very nice base reversal pattern, I would say, and the indicators have been providing really good positive divergence. So I think the probability of an upside from here on increases with that. And the second buy recommendation is on Cochin Shipyard. It has formed multiple bottoms now, and overall reversal in the momentum from here on, it clearly indicates that Cochin Shipyard is likely to bounce back till the levels of 530. One can buy this, placing a stop loss at 490.
Okay, let's move right on then. Those are your mid-cap ideas, Oracle Soft and Aditya Birla that Kunal is also looking at, his mid-cap bet, ABFRL. All right, let's get you news fatafat then. And Neil Mohan, an Indian-American YouTube executive, is going to be taking over the head of Google-owned video sharing platform. In fact, we understand that Susan Wojcicki is now stepping down from her role at the tech giant that she actually began in her garage 25 years ago. The change of guard comes at a time when YouTube is vying for viewing time with popular short-form video app like TikTok, as well as streaming services like Netflix. Meantime, Tesla is voluntarily recalling thousands of vehicles equipped with the company's experimental driver assistance software, which is marketed as full self-driving beta or FSD beta in the US, and the FSD beta system may also have trouble responding appropriately to changes in posted speed limits. Meantime, amid the ongoing standoff and war over the words when it comes to spy balloons, the US president has chosen to dial his Chinese counterpart in a bid to calm tensions. In his most extensive remarks about the Chinese balloon and 3 unidentified objects downed by US fighters, the US president has said the US is continuing to engage diplomatically with China on the issue.
In the meantime, Russian strikes hit critical infrastructure in the western Ukrainian city. Kyiv is considered one of the relatively safer parts of Ukraine at the opposite end of the country from the eastern front. Air raid sirens have been activated in several cities and regions across the country now. Also, no end to the pollution woes in India's financial capital. Mumbai's air continues to remain in poor category with AQI levels well over 220. Now, this comes amid a Switzerland-based a group releasing the AQI for dates between January 29th to February 8th, in which Mumbai was ranked second in the list. Since the turn of the year, Mumbai has constantly recorded air quality levels in excess of even New Delhi. And India will be taking on Australia in the second test of the Border Gavaskar Trophy starting today in New Delhi. India lead the 4-match test series 1-0 in their first test in Nagpur. At New Delhi, Cheteshwar Pujara will become only the 13th Indian player ever to play 100 test matches.
All right, bracing ourselves for what could be a soft market open, but in the run up to that, let's also understand which other stocks are in the spotlight and what's the cover on D Street. And DLF has launched its much awaited Gurgaon project, which is spread over 25 acres. Let's find out a little bit more. And Pankaj joins in with the details. Pankaj.
So, as you pointed out, the cover on D Street is that DLF has launched an important project, which they have, the Armor, which is a 25-acre project that they have. It's about 15 to about 1600 sort of total stories that they have in terms of the entire flats that they are likely to sell. So it's a very big project. It's something which they have invested for, and it's finally seeing a launch. What also the street buzz is that a lot of EOIs have been signed, which means some of them may actually be go ahead and converted into sales as well. So the demand for the product also seemed to be particularly high. The base pricing is in line with what the street was anticipating, close to 17,500 to 18,000, and channel checks, as I told you, for a 1,500 for number of apartments that they have, which is 1,500. You've already seen a 2,000 sort of EOI, which have already been signed. What does this indicate is that the pre-sale guidance that the company has given of 8,000 crore could be easily met. This could mean about 3,000 crore sort of pre-flow coming in as far as the company is concerned. So an important trigger, anticipated event coming in on time with inline pricing.
Index calls then. Thanks very much, Pankaj, for giving us that cover. Moving right on, let's find out what our chartists are saying about the index. Well, no surprises, given the kind of move that we've seen play out on Wall Street, that commentary as well with respect to a very hawkish stance being taken. It's a hold call coming in across the board from our chartists. This despite the fact, by the way, that we were above the 18K mark and we've seen a rise in the markets for the last few trading days on the trot, and the fact that FIIs continue to remain net buyers. So that's the Nifty consensus call. The Nifty Bank as well. That's the view coming in from all three of our chartists. They believe that it's a hold recommendation on the Nifty Bank index. Remember, we did see that index soften tad in yesterday's trading session, and that's exactly what the market moodometer is reflecting.
Actually, Indian Hotels and Mahindra Holidays, these are two stocks which have done rather well. And now the point is that we're talking about pizza sales slowing down, car sales slowing down, watch sales slowing down. Titan never came out with good set of numbers for the quarter gone by. So I just wonder that how long the uptick in some of the hotel and some of the hospitality stocks will continue. I mean, Zomato coming out and saying that, look, we are selling less. The delivery business is slowing down. That's like a revolution of some kind. And Domino's has come out and said that we are trying to sell pizzas, but we're selling less pizzas because of the slowdown. That is something which is quite intriguing. The stock which I want to discuss is Piramal Enterprises. And Kunal, every time it appears that the stock is trading 80 for a breakout, it just fails. I mean, there is a similarity in the Nifty chart and the Piramal chart. Dono mein breakout nahi hota.
Yeah, it's not breaking out, but I think the only point of solace for Piramal Enterprise, at least in the last 3 months, is that the stock has stopped falling, because earlier the stock used to be one of the few candidates which we typically look to short whenever the stock gets into a rally mode. At least that kind of a tonality has changed for Piramal Enterprise. The base, I think over the last 4 months, the stock has consistently tested that level of 800. And in this 3 attempts or 4 attempts towards that 800, 820 mark for Piramal Enterprise, the stock has formed a higher low on the RSI. Now, these are classical signs of divergence. These trends, they start off very slow and gradual, but once the momentum picks up, once the breakout accelerates, that's where we see the trend intensify. So I would probably expect Piramal Enterprise to get into that breakout mode. 885 to 895 is the breakout point for Piramal Enterprise. That also, I think, coincides with the 200 DMA for the stock.
Let's look at some more stocks which are in news, and we'll pull that new graphic up. You've got not too many stocks which are in news, but Schaeffler India, that is in news. You definitely will see Minda and pre-call. It's quite intriguing. I haven't seen this kind of a move that a competitive promoter comes out and they talk about what is happening to. They're looking at buying a stake in a competitor. They come out and they trigger an offer via reverse book building, and the promoters are saying, look, we are not participating. Those are some of the other stocks which are important today. DLF, they've launched a new project in Gurgaon. Minda Corp, we've already heard from the management of Precov. They are saying no ways, we are not selling our stake, and no promoter share is also pledged. Adani Group management is looking at bringing the leverage ratio below 3. How will you do it? and when will you do it? So that's an update on the Adani group. And Maggi volumes have fallen because of price hike and because of grammage cuts. So just think about it. Pizzas are not selling, momos are not selling, Maggi is not selling, and Nestle, which in a sense has commanded a dominant market share because of the categories they represent, they are not feeling the heat. So a lot of disposable middle income groups are feeling the heat of inflation, and that's the point which I'm trying to bring out here, that we cannot be ignorant to what is happening to that end of the market. But as you walk into trade this morning, let's recap the global setup for you once again. Out and out hawkish comments from US Fed. Out and out hawkish comments from US Fed. There was no tone or shade of even any kind of dovishness in their comment. The key indicators which matter to you when you are understanding the impact of US Fed is the dollar index. Why? If US economy is strengthening, dollar will do well. 104 for the dollar index. 10-year paper 3.86. It's not at a 4% or 4.4%. So it's not like a scary scenario, but it is something which is going to make you edgy. And then you got crude, which is at 84.6. So as you walk into trade this morning, there is going to be a gap down start. FIs are buying. So will the gap down start be bought into, or what we've seen in this week, maybe a touch and go moment with 18,000, and then it will be back to square one. 20 seconds to go. I'll let the wall do all the talking in terms of where the market is about to open. It's been a dull week for the market. Dull week both in terms of price action and also in terms of relative news flow per se. 5 seconds to go, and the first rates will just start come up on your screen. I'm going to let my Bloomberg screen do all the talking. Just bear with me. There you go. The first rates any second now. Nifty is off to a flat start. Sensex is off to a negative start. Nothing in the mid-cap space is also looking anything exciting at all. Let me just first spot the real volume movers here. You got Prince Pipes 7%, 4% higher for. Now it's subsiding. Prince Pipe must have seen a block deal. Now it's come down. You got Adani Power, which is up by 4%. You got Precall, which is up by 4.5%. Yes Bank is not going anywhere. Zomato is not going anywhere. Punjab National Bank is not going anywhere. So nothing in terms of large volume gainers which I can identify for you. Now let's look at some of the value dominated stocks. Reliance flat start, IndusInd Bank flat start, Nestle flat start, Tech Mahindra is relatively reversing, and Adani Port is the only one. Adani Power is the only one which I can identify as a stock where the price action and the volume action right now is looking decent. Aisha?
Just looking at some of the other buzzers in trade, and more importantly the newsmakers. I want to see what Precall is up to, what Minda Corp is up to. Both those stocks will just come up for you on your screens, because while we've not heard the side of the story from Minda Corp, it seems that they were looking to buy a sizable stake in Precall via the open market, and one part of the block deal has already happened. Minda Corp holding up 5.5% in trade. Let's see what Precall as well is up to and where it's settling in at. A lot of telecom data coming out, and Jio has increased the monthly subscribers quite a fair bit. In fact, they currently stand at 17.8 lakh subscribers, and this is the November data that I'm talking about. Vodafone, of course, has lost about subscribers once again. The December loss stands at 24.7 lakh subscribers, and by the way, for 21 consecutive months, Vodafone Idea subscription levels or subscriber count has only been decreasing. Vodafone Idea down about 0.6%, and Bharti has added more than 15 lakh subscribers in the month of December as against to the 10.56 lakhs which it stood at in the month of November. So these are a couple of stocks which are in focus. Railtel once again has bagged an order from the Bangalore Metro Rail Corporation. Schaeffler India came out with its numbers. The EBITDA is up almost over 20%, margin uptick of about 40 basis points. There's of course HAL and Bharat Forge as well, in now an MOU with Defence Ministry for development and production of aero steel alloys. So look out for this space. In fact, HAL, BEL, the entire defence pack was on a tear yesterday, and this entire pack continues to hold a buzz even today as we speak. Let's see what HDFC is up to. That sizable bond issuance we've been talking about. We heard from KK Mistry as well on that same. 0.5% lower is where HDFC has started off in trade. And now, of course, I want to check in on the big move that you had in ONGC yesterday, or for that matter, what we've been seeing on TechM for the last two trading sessions. TechM, remember, has put on almost about 11% in the last two trading sessions. Today, it takes a bit of a pause, 1.25% lower for TechM as we speak. For the Nifty, yes, we've gone back to sub that 18K mark, but Kunal, it's a less than 0.5% downtick at a time when you had an over 1% fall for US equities across the board. This is not bad.
Yeah, it's not bad. Even the list of stocks which I was actually looking at, there's hardly any major percentage cut into these names. And I'm talking of the names which have been showing good price action for themselves over the last couple of days, which means that it's not an immediate withdrawal of positions or unwinding of positions into these stocks. Traders are still watchful. They would probably expect that maybe the first couple of hours of the market settle off, then they would probably build onto the positions and the gains which the stocks have shown the last couple of days. The stock which I would look to trade in the opening would be from the mid-cap IT names. First source solution, I think, is something which looks very attractive on the charts. 118.19 is where the stock is trading right now. Looks attractive for a potential near-term target of 128 plus.